as part of the program information for that piece of the conference. And now we'd like to invite up our panelists for the next session, which is From Donuts to Doggy Daycare, creating win-win partnerships with entrepreneurs through preferred equity control investments in proven differentiated business concepts with scalable models in the multi-unit space. That is maybe the longest title we've ever had for a session. Congratulations, you guys win the prize. We're really excited to have you here. And thanks for joining us.
Thank you, Ben. And I was trying to win the prize by doing that. So I'm glad we did win. While we wait for everyone to get seated, that Barry Cohen was pinging me for a title for the panel when I was busy on something, and he'd been bothering me for a while. So I just came up with the stream of consciousness and sent it off. It is a little bit long. So I'm John Royer of Royer Cooper Cohen Braunfeld. It's very nice to be here and to introduce our excellent client, NewSpring Franchise, and my colleague Alyssa Brodzinski. So the shortened version of the title is From Donuts to Doggy Daycare, creating win-win investment partnerships with entrepreneurs leading scalable multi-unit businesses. Still very long, not quite as offensive as that though. It's when I had a chance to think about it a little more. So very briefly, by trade, I'm a corporate M&A lawyer of too many years now. Lots of different, some big firms, some general counsel positions of technology companies, and a co-founder with Barry Cohen of RCCB 10 plus years ago now. We've had a long-standing relationship with NewSpring Capital, which is one of the largest private equity venture capital firms in this region, 2.7+ billion under management, hundreds of deals, and 5 distinct investing strategies, really. And I guess I was lucky enough a couple of years ago to be introduced by NewSpring Capital's president to the guys who were going to run the newest, the 5th of these strategies, and that's NewSpring Franchise. And that started off a great new NewSpring relationship for us, for the firm, and it's been wonderful so far. I'd like to introduce first the 2 general partners of NewSpring Franchise, Patrick Sugru and Satya Ponnuru, and let them each introduce themselves and maybe talk a little bit about their background and how they came together. I'll introduce Alyssa.
Great. Can you hear me okay? Yeah. My name is Pat Sugru, and my background is consumer packaged goods. So the kind of title he put up there, you know, we keep them to 2 or 3 words, and it was clear that was not a consumer packaged goods title, but nonetheless very comprehensive, like all the work that Royer Cooper does for us. My background, consumer packaged goods, a Gallo Winery, Coca-Cola Company, and from there I ran franchise businesses, multi-unit consumer businesses like the Honey Baked Ham Corporation, 500-unit franchise business, largest fine meats company up in Canada called Safina Foods, $1.6 billion entity. And then I came to Philadelphia about 6 years ago. We bought a company out of bankruptcy called Salad Works, which was a center of the plate salad concept. It was very on trend, and we did a nice turnaround there. And from there, it felt like there was an opportunity. I really was attracted to the capital light nature of franchise businesses, and that if you could make the right bets, if you could pick the right brands that had the right connection with the consumer, had great unit economics, could leverage technology to be more relevant, that you could find some really good investments. And look to raise my own fund. Someone told me, you know what, you need to meet the people from NewSpring Capital. Your model of having an operator intensive private equity fund has been done for the last 22 years. So it wasn't such a creative idea after all. NewSpring Capital and our founding partners have been doing it. And part of the magic there is that they partnered up someone with deep operating expertise like my own with someone who has deep investment expertise. And so I was invited to a dinner. I met Satya Ponnuru and our founding partner, Mike DiPiano, and it was just an immediate connection. and a real shared, kind of guiding principles and how we saw the opportunity. So that was 3 years ago. And like my history of having a child on January 1st, missing a tax deduction and a number of other poor timed life events, we launched this partnership as COVID was taking off. And as Neil Book says, it's the best of times and the worst of times. In many ways, for us, it was the best of times because a number of businesses and founders were looking for help on how to take their business to the next level, which is what we do. So, Satya?
Thanks, Pat. As Pat indicated, NewSpring franchise has been built over the 22 years by building strategies that bring together operators and investors to allow us to better source, diligence, structure, and really add value to our to our partner companies post-close. As Pat just walked you through, he spent the last 25 years having led multiple brands across the industry. And my experience has been pretty complementary. I've spent the last 20 years on the investing and finance side of the business, with the last 15 years really investing in lower middle market private equity firms, starting out really as a generalist, and actually worked at another firm where we worked with one of the strategies at NewSpring Capital, the NewSpring mezzanine strategy. And my first investment alongside NewSpring goes back about going on 10 years now, in a little packaging business that we invested into. And at the time we were doing about $2.8 million of EBITDA. And 7 years later, we're at $14 million of EBITDA. And we really get to know each other, get to see each other, understand how we work with founders, and really how we add value. Over that period of time, I started spending more and more of my time investing in restaurants and other multi-unit type businesses. The most a later one of which actually again invested alongside NewSpring in a breakfast, brunch, and lunch concept that's done quite well, continue to do well during the pandemic. And through that experience, they saw how I partnered with founding teams, how we structured investments, and how we helped them post-close on the boards, et cetera. And so they reached out and said, hey, look, we're thinking about adding a new strategy here. We think this is a very unique sector, despite the many words that John's brevity has used. It's a fairly simple industry. It is an industry that every one of us interacts with each and every day, whether it's going out and buying food outside the home, going out and whether it's home services to help us fix our houses, whether it's dropping our dogs off on pet services, fitness, youth enrichment. These are all very things that we all increasingly spend our wallet share on each and every day. And so it was a very unique idea. And as I was investing, formerly, I always sort of had this feeling that having an operator that had sat in those shoes through that entire process on the early side of it could be extremely useful and highly additive. And as Pat said, literally, I think we first got together in September of 2019. And we were supposed to meet for a drink, and I ended up intruding on his and his wife's date night out and crashed their dinner, which I've subsequently done. I've tried to limit the number of times I do, but it was really, what he was looking to do and what he was looking for was the exact piece of what I was looking to do and looking for. And so it's been just a fabulous partnership. But as all great partnerships, we've had a great team surrounding us, both within NewSpring, but also having great partners outside of NewSpring, including an incredible partnership with Alyssa and John.
Well, that's a good segue then to when NewSpring franchise the opportunity was referred to us by NewSpring Capital, needed really a team leader to be able to run transactions and be a great fit, both skill wise and personality wise. And so tapped without question, Alyssa Brodzinski. So Alyssa, why don't you give a little background on yourself?
Sure. I'm a partner in the corporate group at Royer Cooper Cohen Braunfeld. I've been there about 7 years now. My background is I worked at two very large international firms, one based out of New York and one based here in Philadelphia. And then I moved in-house. So I had the opportunity to be the client for almost 10 years as well. And then transitioned back to Royer Cooper. And I think that's given me a really unique view on how to represent clients, and it colors how I interact with Pat and Satya and the rest of their team. Really getting to know them well, understanding sort of what their pressure points are, and sort of cutting out some of the red tape and blockages that sometimes come from the legal team, and really working as their partner in the transactions.
Excellent. Well, we talked a little bit about the, I guess, the origins of NewSpring franchise and how you guys were first introduced. Let's take it a little further, and how you developed and what you're really looking for in the initial businesses. We'll talk about the initial businesses in a minute, so let's not get into that yet. And then talk a little bit about, the types of deals that you're trying to structure, and then we'll get a little bit granular into that as well.
Sure. So as I said, what we're investing in are fairly tangible and easy to understand businesses. They're multi-unit consumer service businesses. It's about $1.5 trillion out of the economy, which is obviously quite large. And about half of that is made up of food and food-related businesses, and the other half of that is made up of a wide variety of consumer services. The largest category probably being home services, but then you've got personal care, pet services, youth enrichment, fitness, et cetera. And all of these businesses and the industry as a whole is growing at a disproportionate pace relative to the broader economy. And it's growing because of all of us and the way we spend each and every day. As you go back over 20, 30, 40, 50 years, each of us are spending in a different way due to fundamental consumer demographic and fundamental consumer behavior trends. On the consumer demographic side, probably the largest driver is just an explosion and significant increase in dual income households that will not stop. Last year, Wharton's graduating class had more women graduates than there were men. And so that will not change. And so what that's led to is a lot more households that have a lot more income, but way less time. And so that leads to a significant outsourcing of just about everything that's getting done. I think in a number of the things that we've worked on, Alyssa's like, you're talking about me. And so that's a big piece of it. Consumer behavior is changing rapidly. If we've got children or grandchildren, millennials and Gen Z, their spending patterns continue to be very, very different. They outsource more and more of their entire lives. Anything that can be outsourced, they will outsource. And we don't anticipate that changing anytime soon. And so what you end up with is a big, large industry that's really growing at a disproportionate pace. And these industries are just massively fragmented. You tend to have mid-single digit market shares amongst the market leaders in any given subsector that we're investing into. And the largest part of the growth is occurring within the smaller component of the businesses. That's where Pat and I invest. We invest in the lower end of the middle market of these emerging brands that have proven businesses, proven products, proven customer value propositions, and a proven set of units. So we're not taking any of that risk. What we want to invest into are these great brands that have already been proven out, where the founders need a little bit of help to be able to put some gas on the fire and explode the unit count. That's where we come into play. Quite frankly, the financial capital is actually the easy part. And in many ways, that's the commoditized part of our business, the differentiating part, and why our our partner companies partner with us is really not just the financial capital, it's the human capital, it's the expertise, it's past 25 years having sat in that seat and being able to tell a CEO with conviction what's going to come around the corner. that's what they're looking for. When they need help finding a franchise development professional to go execute on that plan, who do we find? How do we find that person? Once we find that person, are we going to know if that person's good or not? Can we attract that person? Our capital and us being able at the table allows these businesses to attract and retain a completely different caliber of human capital. So that's where we focus, really lower middle market, emerging brands that have huge growth potential.
Why don't we talk about the initial deal? So the title starts with From Donuts to Doggy Daycare. Maybe people notice we have 2 varieties of donuts over there. 2 of the 4 initial deals you guys have done are with donut store chains, which we'll talk about that a little bit later in terms of the potential conflicts that were resolved within them. But maybe give us a little background on each of the 4 companies that you made your initial investments in.
Yeah, our first one is Global Dry Bar, and it's a blowout salon that basically that has kind of been a decoupling of the services that come from a traditional salon where you might be in there for 4 or 5 hours with a cut and a color and then the blowout. The most transformative part of that service is the blowout. And as we said, you know, what we're studying are the things that really have a strong consumer value proposition. And as you can probably tell, it was hard for me to identify with that value proposition, but having
It was even harder for me.
Fair enough. And but having a professional daughter in New York City and a wife, and you saw it, and Satya and I, you know, we went out to a number of these salons, and you could see these women who, as Satya said, are overscheduled. They're doing everything. They're superwomen. They're Alyssa, frankly. And you see that person, you know, walk into this salon, they call it a bar, aptly named, but the only alcohol is a little Prosecco, but that's a good enough after a tough day. See these women walk in with a ball cap on, you know, kind of, you know, trudging in. They sit down, they're taken care of for a few moments. You know, nice smells, sounds, people kind of visiting, drinking that Prosecco, and they walk out like they're on a red carpet, and you see the bounce in their step. We knew, although not firsthand, we knew this had a very strong consumer value proposition. And so we further went through what were the unit economics, and there was some 2-to-1 sales to build out ratio. That's a good sign. We looked at the reality that from scheduling and marketing, there were technologies they weren't deploying that we could use the capital that we put on the balance sheet to accelerate their sales and streamline their operations. And so we saw that was a key fit. And then the fourth and always crucial is leadership. The woman who led the company was a Procter & Gamble executive who had an MBA from Northwestern. She embodied the brand and was a very strong leader. We felt that she had not only the ability to grow this brand from 80, 90 units to 200-300, but that she could really be a leader for a platform of beauty services. And so we get very excited about that transaction. The couple of complicating factors, one was the fact that it was a Canadian company, and we were going to need to move that to the US, and all of the human capital issues that come with that, and you know, tax implications, et cetera. And felt very fortunate, as Satya said, you know, find the capital, that was the easy part because the value proposition was so strong. The challenge was, you know, dealing with all those structures and coming and optimizing that. I guess I'll turn it over to you to talk about some interesting legal.
Sure.
Yeah.
So, you know, they never make it easy. The first transaction we did with them was a cross-border transaction. So we engaged Canadian counterparts on our side. The lead counsel for the other side was obviously Canadian counsel. They had engaged US counsel that was not particularly sophisticated. So that presented one challenge of working with them. The model for these businesses, I don't know if we talked about it a lot, but it's sort of a hybrid deal between an M&A transaction and a traditional venture capital transaction. These are control investments, but the founders in most cases maybe taking some money off the table, but are retaining significant ownership stakes to incentivize them to stay and be the operator partner going forward. And so, we are very familiar with that type of transaction, but the council on the other side was not. So we had to familiarize them with the transaction documents, worked very closely with both accountants and Canadian and US tax counsel to restructure the business into a US holding company that we invested in. And again, to try to get as much favorable tax treatment as we could for those founders who took a fairly significant amount of money off the table, some of whom the initial investors exited completely the deal. So that was probably the largest challenge in that transaction. The other thing that's unique here is we're not franchise lawyers. So we've partnered with franchise counsel that NewSpring has selected, who partner with us in reviewing, the fairly complex disclosure documents that have to be provided, and which are regulated by states in the United States, also in Canada, these disclosure documents to any potential franchisees. So working very closely with outside counsel on both sides there to make sure that everything is in line there, because the penalties for screwing that up are fairly significant. So, diligencing the deal for the investment we're making, but also to make sure that everything is ready to go as they scale up these businesses once the investments are made. Similarly, the employment laws in Canada are very different than those in the US. They're much more favorable to the employees. So we were putting in place executive employment agreements for the CEO and making sure, obviously, that we were following, the letter of the law in Canada in setting those up. So that's probably the most interesting fact about that particular transaction.
Let's talk about some of the other portfolio companies then. We've got a couple of different donut companies. Maybe Satya, talk about Duck Donuts.
Sure. So our second investment, we tried to make a little bit easier and certainly easier to explain, donuts. So the consumer value proposition there was Pat and I could actually really try it out. Duck Donuts was founded in about 15 years ago. Down in Duck, North Carolina, and it's so many businesses in the sectors that we're investing in to get their start. An entrepreneur has an idea, wants to start a location. That location has some success, it begets another location, and through those experiences and through a great brand and a unique product and customer value proposition, has other people saying, boy, I could use one of these in Pennsylvania, in Virginia, wherever I live, and says, can I franchise it? And it's funny in our business, so many of the founders of these franchise businesses stumble into franchising. They don't necessarily have that experience or have that background. And they launch it because of a need in the market and a opportunity. And so the founder here did just that. And he grew the business quite successfully. Over the next 10 years, he grew it to about 80 franchise locations, which is quite a bit, including locations everywhere from the Northeast out to California. And he started realizing that, wow, I need some help. I really need some expertise. He started hitting some blocks operationally and some real challenges. How do I build out my organization? How do I support a team? And he realized I need a partner to do that. And I need a partner that has been there before and has done it before. And so we were introduced to the team back in the fall and winter of 2020. And started working on this one as we were completing the investment in Blow Dry Bar. And so we completed that investment in the first half of 2021. I'd say this one, after going through our cross-border experiences, employment experiences, all the challenging things that made Blow such a fairly complex transaction. This one was probably, on a relative basis, fairly neat and orderly, as far as neat and orderly goes in these sorts of transactions. And so we got that done in the first half. We've been, and both Blow and Duck have really been great case studies for us as we've gone out and made multiple investments beyond those first two. And now as which we'll talk a little bit later, but as we transition our own strategy on how we're investing on a go-forward basis. But both of them have really worked out quite well.
So the next deal was Central Bark. Maybe to give just a brief overview, and I know there were some interesting legal issues that were navigated in that one too.
Central Bark, a dynamic during COVID, 20 million dogs were adopted, and they were part of the family, and they helped us endure the isolation and loneliness of COVID. And they weren't particularly well socialized or trained, and suddenly coming out of COVID, we want to travel again. We're going back to our offices. What are you going to do with that member of the family? And so that our thesis was, this was a great space to be in with the number of pets that are out there. We acquired Central Bark, which is a 35-unit franchise, third largest franchised dog daycare business. Despite its size, it was by far the state-of-the-art platform for dog safety and care, and for accommodating the owner's wishes. And so we felt like, while it was the third largest, we felt this was a platform that we could really grow very quickly. And two founders, interesting enough, they were at a stage of their life where they wanted to be involved, but they didn't want to run the day-to-day. So this is one that, with part of what they were looking for us to do, is be able to place a great CEO, as well as put together franchise development resources to go grow the concept. And so this transaction came together in, I think it would have been November of 2001. In that 8 months since, to give you an idea, our timing was really good. The thesis, has been validated. Average unit volume, the revenue per location, is up 60% since we made the investment. So we're really honing the model and now on a growth strategy for units.
Alyssa, why don't you talk a little bit about some of the complications in that deal?
Sure. So this deal was interesting. There was a number of founders who had been part of previous dog related businesses and still had some ties to those businesses. So we had to be really careful in diligencing, making sure that all of the assets that needed to be there to run this doggy daycare business were actually owned by the company that NewSpring was investing in. And in fact, when we did our diligence, they were not. The IP was all sitting in a completely different company that we were not investing in. So we had to get that all transferred and re-registered. There was another business using some of the trademarks that was affiliated with one of the owners who was not an owner of this business. So there was some negotiations that in fact lasted longer than the closing to try to figure out how, was that entity going to become, a franchisee, or were they going to cease using the name? Something that came up in a number of these deals since we started during COVID is we had both the companies who were investing in themselves that had COVID relief loans, both in the US and in the case of Blow Dry are in Canada. Many of those loans were, as you probably know, at very attractive rates and in some cases forgivable. So the owners were very loath to give them up. The negative there is they weren't really transferable because the idea was they were supposed to stay in the businesses to keep them open during COVID. In one case, in Duck Donuts, we actually delayed our closing so that they could get that loan forgiven because we really had no choices other than to repay a loan that would get forgiven. So the founders didn't want that to come out of their proceeds. So that is from a number of deals, but we also had, probably more so than you would in other times, you had to look and see, did you have franchisees that were in default of their franchise agreements, in default under the leases? Sometimes, very rarely, but occasionally there would be guarantees given by the parent company of a franchisee's lease. So, you know, although in the franchise business, those lease locations aren't leases of the parent company, you do have to look through and see what other obligations might you have had this company sign up that they could be on the hook for, and look for sort of those hidden liabilities. And then there was a number of restructurings too going on here, even with the parent companies and their landlords, you know, to restructure their leases. So a little bit more turmoil in the businesses than you would have maybe typically had in these businesses.
One thing, just if I can add, John, you know, I think the interesting about our acquisitions, we're making a bet on the founders and their strategy and their vision. They're making a bet on us because they're keeping a meaningful stake in the business. But there's an implication for that. And I think probably the only guys who have a worse reputation than the private equity guys are the attorneys. And so between us, we went at.
We can
all-
debate that.
Maybe the other way around. Yeah, you got a good point. But the idea was, these were people we were going to do business with for the next several years. And we wanted it to be a productive, collaborative relationship. And so it was that context that, you know, as we went through each one of these late night conversations about, you know, the next turn of the docs, you know, Alyssa would say, hey, look, we can fight for this, we can win it. You know, is it worth the battle? And here's the implications of this issue. And we'd say, no, it's not that important. Others, she'd say, look, this is something we need to prevail, and this is in your best interest to get. And both as a participant with the other counsel and the sellers, and with Satya and I, it was just a very collaborative conversations. And I think we made really good decisions throughout the process in terms of you know, not winning a battle and losing a war.
That's a great distinction from the type of deal where you buy out a middle market company and the owners walk away with boatloads of cash, and or maybe a very small minority interest rolled over. In your case, your owner team could have 49%, 25, 35% to 49%. So they are, and in most cases they're running or still involved in the business. So you do have to create that win-win partnership going forward while still making sure you do have ultimate control if you need it. So that was the tightrope that we always had to walk in these deals. So last but not least, the Federal Donuts deal, and that was different than the others in that it's all company-owned stores, but it had great franchising prospects, I think, which is an important aspect. And before we talk a little bit about Federal Donuts, I think when Satya first called me about this one, the first issue to navigate was you already had a donut company. And so were they, how similar were they? Were they going to cannibalize each other? Were there conflicts of issues, of interest issues, even for real estate locations? You know, what kind of fiduciary issues do we have to deal with? And obviously issues in contracts themselves and the Duck Donuts investment documents with the investor pool that was brought in. You know, there was in fact a non-compete, although we had watered it down, you know, fairly significantly, but still had to be navigated. So we had lengthy discussions dealing with those issues. And your tact, which was the right one, was really you know, full disclosure with all groups, and bring the concept first to Duck Donuts, their board, their management team, see if they'd be interested in it within Duck. And also at the same time bring it to the investors of the Duck Donuts entity, and see if they would want it in there, or if they would waive their rights to have it be in there, but have the opportunity to invest in a separate deal. And
yeah, it may be worth just taking a step back and going back to the founding of NewSpring franchise for a moment to sort of lay out some of the challenges that Federal Donuts started to create. So when we started NewSpring franchise, the idea was we would make a handful of investments out of single purpose entities, SPVs, and really prove out the strategy, prove out the types of investments we wanted to make, prove out the value creation, and prove out the overall thesis. And once we did that, the idea was that we would go out to market and raise a dedicated pool of capital, a traditional fund to be able to make these investments. And so all of the first 4 investments that we've done have been in SPVs, each with their own distinct investors, though to some degree, not surprisingly, there is quite a bit of overlap, but that overlap may be inconsistent. And so when we completed Flow and then we completed Duck and when we completed Central Bark, they each had their own entities with separate investors and separate stakes. And so we came across this new opportunity called the Federal Donuts. And we were quickly questioned on whether we were just going to launch a donut fund, which, seems more and more appetizing every day. And so, but what really attracted, we had an interesting business rationale for the business for Federal Donuts, which was quite distinctive from Duck. And the name notwithstanding, we really felt like Federal Donuts had an incredible opportunity to grow because they also had just an incredible chicken sandwich and a broader menu to it to be able to operate in a broader fast casual industry. And the concept was conceived and launched by a local chef, a couple of local chefs named Michael Solomanoff and Steve Cook, who were the founders of their flagship restaurant, Zahav, which was named the best restaurant in America by the James Beard Foundation a few years ago. And they were named best chefs in America by the James Beard Foundation. So you can imagine a couple of James Beard award-winning chefs, the type of chicken sandwich that they would create was outstanding. And so we really felt like it had a unique and separate and distinctive growth opportunity from Duck Donuts. That being said, we obviously could understand the potential for conflicts and all those sorts of things. And so it was really great to be able to spend, really just walk through it with John and Alyssa. There's certainly the legal obligation piece of it, which we need to understand. And then there's just the practical component. Us at NewSpring, we've always prioritized the fiduciaries of our limited partners and of our investors, even at the expense of our own. And so it was important first to understand what we need to do and then what the practical implications were. And we had a great game plan through it. First, we needed to go through the formalities and the channels with our existing partner company at Duck, given that the founders and the owners, the operators there own 40% of the business. We own 60% of the business. We ran those traps, and once they got to the point where they said, this is completely different from what we're doing, then we went to our investors and went through the right protocols and traps there. And where we ended up by the end of it was we ended up creating a 4th completely separate SPV. By and large, quite, I think it ended up being about 92% of the investors that were at Duck invested in the Federal Donuts business. So it gives you a sense of what sort of support we got there. But certainly, it took a little bit of time to think through all of those ramifications, both legal and practical.
I know we're running short on time, so just wrapping up with a final couple comments. It's been a great opportunity for us, obviously, to bring a corporate team to bear and our tax, IP, real estate, employment when necessary, litigator to look at things, work with outside franchise counsel and quarterback the whole deal. Alyssa's done a great job with it. I've had input in them, and the team's done a great job. We've interestingly had solo practitioners on the other side and a 650 lawyer national firm on the other side of one of the deals. So that is something that we're used to seeing. We are often up against 1,000 and 2,000 lawyer firms, and sometimes very tiny firms where a litigator is in court all day and then thinks he's a M&A lawyer at night, so it's easier to deal with the 2,000 lawyer firms frequently than the solo shops like that. I know maybe just for a quick word, I know you guys are launching the next stage of NewSpring franchise. I want to let you mention that and then see if there's time for if there are any questions.
We're taking the 4 SPVs, we're marketing and showing how they would perform as a one singular pool of capital as a proof of concept for raising a $100 million NewSpring Franchise 2 fund. We're in market now. We'll probably have a first close within the next couple of months. And so it'll give us the opportunity to invest in businesses like the ones we have done, kind of in that $5 to $20 million equity investment. You know, we're very excited. I have business cards for all of you who want to invest. You know, happy to follow up, but no, appreciate the opportunity to speak with you all. And you know, John said if we did a good job, we could come to your next meeting in Rio. So I hope to all see you all there. Right, John?
Exactly.
Okay.
So any questions for the group?
So being a Canadian M&A lawyer, was the reason that you need to do below in a US holding company because you had direct investment and you created an SPV limited partnership in the US and you wanted to avoid securities, or was there another reason why you needed to have a US holding company for it?
Yeah, so at the time of our investment, Blow was originally founded in Canada, out in Vancouver, and the very initial growth was Canadian, but very quickly the US really became the primary presence. So by the time of our investment, there were about 85 locations, 17 of them were Canadian, but the rest of them were in the US. And as we really looked at the growth opportunity and where the primary focus was going to be, both from a unit perspective, but also a human capital perspective, it was going to be really primarily US based. So when you had that coupled with the investor base, coupled with the most likely buyer on the back end, having the US holdco, because, you know, as Alyssa alluded to, when you're franchising here in the US, I mean, it's almost like selling securities. And so you need to have a US entity for that as well. And so very quickly, the largest segment of income was going to be derived increasingly from the US.
And they did have a US operating company,
Yep.
but we had to flip the structure.
Yes,
around.
and there's still a Canadian operating
is.
company that employs the Canadian employees. So it's thanks to my friends on the tax and accounting side, it's a fairly complex structure. But that's how we ended up with the US parent.
Following up on that, did you guys look at all of further working deal, which was, you know, a similar franchise type deal where the US company decided to go green as part of its action? In that analysis, or we do sort of just knowing that it's interesting.
I unfortunately am not a tax lawyer, so people much smarter than me probably did look at that type of stuff when they came up with the structure, and we spent quite a deal of time on the structuring concept before we even got into the deal negotiations. So
we did, both Pat and I come from backgrounds earlier in our careers where we worked with much larger businesses. I started my career at Deutsche Bank, and I remember one of the first deals I worked on was the hostile takeover of Xstrata by Falconbridge. And when you're working on those big, large $2 billion, $10 billion, $20 billion, you've got huge amounts of resources, tons of different prisms that you're looking through. And some of those tax considerations, quite frankly, sometimes can be the largest driver of value in some of those situations. For what Pat and I are really doing, we're really business builders. We're partnering with founding partners, and the growth in the driver of returns, we're not generating our returns because of financial engineering or tax engineering or figuring out a better mousetrap on, maybe using the Caymans or the Netherlands, whatever it may be. We're doing it through old fashioned, we're taking 80 units and we're going to 300 units. We're taking the 40 units at Central Park and we're going to go to 200 units. And how are we going to do that? We're going to bring on exceptional people to go drive that growth. That's what we're doing. And so some of those things, it goes back to that, we're trying to win the war, not the battle. And so, it's sort of interesting. John talked about, so oftentimes these businesses are small, they don't necessarily get the right counsel, even like John said. I've had in my career where the other side was a workers' comp litigator. And that's challenging. And so what's been so fantastic about John and Alyssa is they've got the bedside manner not to make that workers' comp litigator feel like a dummy for bringing up something that, probably doesn't make sense.
But so in a nutshell, the tax considerations are always important and we look at them and there is usually some kind of restructuring in most of these deals, but it's not always the preeminent factor. And in this case, where you saw the business growing and being, headquartered here, where obviously the investor base is, and you guys leading the the investment was preeminent really at the end of the day. So we also know it's lunchtime.
Yes,
Okay.
thank you so much. We really appreciate it. That was a really great session. And if anybody has any other questions, please grab them on the way out and ask them. I've just got a couple of quick important announcements. Please, if you want to be comfortable this afternoon, change before we go down to lunch. We're going to be walking. It's about 15 minutes. So you'll want to make sure you definitely have comfortable shoes. We are going right to the afternoon tour from lunch. So also bear that in mind. If you can try and be as quick as possible, I would appreciate it. We're also going to meet right by the table, the registration table here. So don't go down to the main lobby. I mean, this is same floor, but just come down and meet by this table and then we'll leave from here. The other two things, one fun fact for those of you who are going to Abe Fisher tonight. Satya had mentioned that one of the founder of Federal Donuts is also the owner of Sahav, also owns and runs Abe Fisher. So those of you who are going there tonight have a fun fact. And for everybody who's confused about where they're going to dinner tonight, it's on the back of your name tag, if you haven't spotted that yet. So that's where your dine around is tonight. You'll also be meeting for your dine around tonight at the same place we're meeting for lunch. Try and be there at 6:30 so we can get you to where you need to be. Okay.
Quick question of the panel, it's the litigator, so I don't really care about structuring and deals. I think of things more as who's right and who's wrong. Do you guys like that, or federal or?
Their lawyer is instructing them not to answer that question.
Lead the fit.
I needed my share.
Boss can tell you. All right, thank you very much.
Thanks for coming out. Speak to you Monday.
You bet, absolutely. Thank you. Right back. Thank you.
Yeah.
Are you going to lunch or back to the office?
I'm not gonna.
Yes. No.
Yeah.